you had a severe deflationary impulse, and we did have one during COVID. Everybody shut down, and then there were some prices of important commodities fell because the consumption was. So when you have this type of deflationary impulse, you have to have a response because you cannot allow that to carry through and cause mass defaults throughout the system.
So you're talking about basically the Fed printing in some way, shape, or form.
I think that's definitely coming. And the question is what's the scale of that? And are we going to arrive there without any deflationary impulse from AI, or is that going to be like a 1-2 punch? Because we have enough kind of stuff going on that we could have some kind of an economic event anyway. And then you start to pile the AI stuff on top of it, it might get really wild.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a different and still fantastic discussion lined up, and we are fortunate to have with us Steve Smith. Steve's been the founder of a tech company for a decade and a half where he built innovative web and mobile applications for businesses of all sizes and provided international engineering staff augmentation as well. He's now the founder of Celestial Mining Management, a financing, site selection, deployment, and management of Bitcoin mining operations company. Steve, thank you so much for joining us today.
Thank you, Gary.
Well, let's begin with the macro picture and how you see what's going on in the economy and in the markets.
Well, I try not to get too caught up into the day-to-day gyrations, but looking at the big picture, it is everything is lining up for another kind of liquidity cycle, and very much in line with the Bitcoin cycle, which we pay a lot of attention to, and the U.S. political cycle as well, which everyone has to pay attention to. So it's all these forces are kind of coming together for a very interesting year ahead.
So, Steve, given your expertise in technology, how do you see the interplay between AI, robotics, and the current unemployment cycle that's starting to tick up? Will these advancements exacerbate job losses? Will they create new opportunities? And how might the widespread adoption of AI and robotics impact the ability of laid-off workers to find new employment at some point in the future?
Well, that's a fascinating topic, and I really like to pay attention to just the biggest trends that I see happening. And of course, the two that I focus on are Bitcoin and AI, and I think they're very related. In terms of the AI stuff, I use it every day, and it has multiplied my personal productivity. But I look at, as a business owner, it also can postpone, let's say, hiring. You might wait to hire a little longer if you can do more. And I know that large organizations are looking at it as a cost-saving technology, potentially labor-saving, and you can expect that there will be some disruptive period there. I just don't know how big that disruption is going to be. And, like all new technology, it should lower costs and increase productivity, which is a deflationary pressure. And that is going to stimulate a very strong response in a debt-based system because we really can't sustain massive deflation. So you have temporary dislocation through the labor market changes that we're going to have. And then you're going to have the macroeconomic response to those situations that's going to be a driving theme over the next several years.
Okay, so that's interesting the way you just put that. And I'm assuming that based on the temporary dislocations, you're referring to the fact that you believe that although AI will take some jobs, people will retrain and they'll come into new jobs at some point on the back end?
The younger you are, the easier that's going to be. There is retraining to do. I think older people need to think about how to leverage the AI to be more productive in whatever it is that they're doing. There is tremendous demand for skilled people who know how to manage and operate things, and to conduct business. The younger generation is not always as sophisticated in those regards, and so there's a lot to be said for age and experience.
True.
However,
okay.
the younger people are going to adapt to this more quickly. The need for face-to-face interactions or in-person delivered services, I think that those are going to be some of the especially skilled labor that must be delivered in a particular place in a particular time. Those are some of the last things that are going to be affected by this.
Yeah.
Your plumbers, your electricians, they're going to continue to do very well.
Maybe even better than ever, right?
Maybe better than ever, but it's going to cause us to take a look at a lot of the job roles that we have developed, while we deployed all this information technology over the last 30 years and the internet and communications. It's created entire new job categories. And some of those are very exciting, and some of those are probably going to be affected quite a lot by automation and by AI agent technology and such. There is a difference between like where we are today with the AI stuff and the, let's say, the hype. Okay. It is real. The technology is really useful. I used it this week to do something that would have taken me days, maybe a week or two, and I got it done in 48 hours, turnaround count, clock time, right? Had to sleep some. But it was a tough task. It was done under pressure, and those are just things that I would attempt today that I wouldn't have. I would said, "Oh no, we can't do that. I can't do that." So it is exciting and it's real in that regard. But I think the real promise of this is when we get to some more autonomous agents that are doing work on your behalf, a little bit more like a human employee would, where you can give them some high-level instructions and they can kind of go to work on trying to get something done for you. Systems that monitor things. These are all very real possibilities now, but they're still possibilities. And it's not like you can just install an app and it's all magically works for you now. Right. So I think there's some work to do on the plumbing to get this technology out. What most people are experiencing right now are these large language models, the chat GPTs, Claudes, and some of the other tools that are out there. Those are an important component. And I think that the infrastructure and ecosystem that grows up around them is where a lot of value is going to be delivered.
So as a technologist for so long, for decades, do you look at what's happening in the market on the tech side as similar to the .com timeframe, or do you think this is different?
There's always a hype cycle that comes along with a new technological wave, and it seems like in technology, a new train leaves the station every 5 years or so of major import. Okay, but AI is probably, and I would put Bitcoin in this category as well, is probably on the category of the importance of the internet itself. So major theme. These do not come along every year, and they take sometimes decades to play out fully, right? So this is a major theme in that regard.
So you had mentioned previously about deflation and a potential response. I'm assuming you're talking about the Fed responding in the event of deflation, a strong deflationary impulse caused by AI. What would you go ahead and explain what you think there could possibly happen?
Well, the debt-based monetary system that we have today requires continual expansion, and it it really doesn't want it, like it needs inflation. Now, what they found is that there's a tolerable level of inflation, and if they can just keep it within these tolerable levels, the whole system can kind of run, and people are not too upset, and the society doesn't, fall apart as quickly as it might otherwise, and so we can kind of keep going for maybe more decades like this. I don't know. But if you had a severe deflationary impulse, and we did have one during COVID, everybody shut down, and then there were some prices of important commodities fell because the consumption was. So when you have this type of deflationary impulse, you have to have a response, because you cannot allow that to carry through and cause mass defaults throughout the system.
So you're talking about basically the Fed printing in some way, shape, or form.
I think that's definitely coming, and the question is what's the scale of that, and are we going to arrive there without any deflationary impulse from AI, or is that going to be like a 1-2 punch? Because we have enough kind of stuff going on that we could have some kind of an economic event anyway. And then you start to pile the AI stuff on top of it, it might get really wild.
So the law of diminishing returns talks about how for every time the Fed prints, there's less GDP growth that occurs. And I think the last time around, it was about 55 cents on the dollar. So for every dollar that they printed, they got back 55 cents of growth. Do you think that they're going to print despite this diminishing return, or do you think they're just going to eat they're just going to eat it and accept whatever the consequences are of the economic circumstances at that time?
90% chance they're going to print. Okay. Like nobody wants to take the pain. The story from my adult life has been always to put off the reckoning.
Kick the can, right?
I've known this was coming since the 90s, and watched, we went through 2000, we went through 2008, we've gone through COVID, and each time they managed to save it just barely, and no one really wants to do the hard things that would be required to clear out the bad debts, to rationalize our investments. We've got a ton of malinvestment, and that, to do that right, we would have to liquidate a lot of that and get it righted off. We would have to shrink the federal government. Right now, it's spending 38% of that GDP. So when you're talking about GDP growth, we're getting all of the growth that we get right now from the growth of the federal government, while the productive sector of the economy is actually anemic or not really growing. And so, if you subtract the federal spending from the picture and transfer payments and all these things, you could say that we've been in something like a depression for a while. Yeah.
So. Okay. But yeah, I understand the picture that you're painting, and quite frankly, I agree. Well, let's move over to Bitcoin. How would you describe, just in general, what Bitcoin is?
Well, there are about 20 or 30 sentences that begin with "Bitcoin is," and they all are analogizing to try to communicate something that that you can relate it to. Bitcoin is Bitcoin, so it is a thing. Now, we can describe its properties. It has properties that its proponents, including myself, would argue are monetary properties. They share some things in common with gold. So one thing that people early on grabbed onto was the analogy to like a digital gold. And in fact, that was described by its creator, Satoshi, by way of analogy in some of his early explanations of Bitcoin. So a digital gold, I think of it, my personal description is digital, a sound money for the digital age. So if you understand what sound money is, and your gold and silver people would all know what that is, then a digital sound money It may sound like an oxymoron to some, but if such a thing could exist, it would be Bitcoin.
So based on your correlation of Bitcoin to sound money,
Mm-hmm.
why would, and all the macro developments that have already been laid out in our earlier part of the discussion, why do you believe that Bitcoin is going to play a major role in the future?
Well, it is based on the analysis of its properties and the incentives that it sets up. So when you understand that it is scarce, okay, that's the first thing. You have to accept that it is a scarce digital asset. Most people, their experience of everything digital is like, I send you a photo and now we both have copies of the photo, right? And so, is that scarce? No, not really. We can duplicate it as many times as we want. And that was one of the problems early on with digital commerce. And I was involved in this back in the mid 90s, late 90s. There was a lot of discussion about digital commerce as the internet started to be really come into the fore. And it was always envisioned that we would one day be able to conduct commerce directly over the internet. But there was no technical solution for this simple problem that if I hand you a file, we both have the file. The analogy with money is that if I give you $1, I don't still have the dollar. You have it now, right? So that we call that the double spend problem. And that was the fundamental problem that was solved by the creator of Bitcoin, was the prevention of double spending. And so once you understand that, then you kind of look at the rules of the system and how it's all set up and who's incentivized to do what. And you realize, well, as more people understand it, it becomes more valuable. Now we have examples of this, like the internet early on had tremendous promise. But when I got on the internet, it was a system for basically nerds attached to institutions. Okay. So it was kind of an elite, obscure thing. And I would run around telling people the internet's going to change everything. And they're like, inner what? Okay. Fast forward 30 years later.
Unless they were listening to Bill Clinton, then they knew it. And they knew it.
Right. So 30 years later, we know how that went. But we also have systems that are more recent vintage, like the Facebooks and the other social networks, to understand how the value of a network increases with the number of network participants or nodes. So as you join Facebook, you're actually adding value to Facebook. And we can look at monetary systems as networks too. So the dollar system is a network, right? And everybody who can trade in the dollar system gets value from that. And the more people that can trade in that system, the more value can be offered to the other trading partners in that system. So you apply this framework to Bitcoin, you say the more people that have Bitcoin, that were willing to accept Bitcoin, that will hold Bitcoin, they are the nodes of this network. And you can see that it grows in value just from that kind of exercise.
That's interesting. You've mentioned gold several times. What's your view on gold and the role that it'll play in both personal and global finances moving forward?
Well, until Bitcoin came out, I was a gold buyer, and I still have the gold that I bought for the Bitcoin. So I understand gold. In fact, I was an early user of some of the systems like eGold, and there were some monetary gold attempts to make gold more digital early on. And some of those unfortunately resulted in legal problems for their creators and other things. But that's a space that I've always been interested in. And as an advocate of sound money, that was really our only option for many years. So that said, I do look at Bitcoin priced in gold. And there are times when, if you want to stay in sound money and you kind of like gold too, there are times when you might want to be heavier gold or heavier Bitcoin. And so that's an interesting chart to follow and to look at the cycles there. If you're going to trade out of Bitcoin, for example, because you thought there's a temporary kind of a bear market going on, you probably want to be holding gold.
So Bitcoin was created to have 21 million individual Bitcoins in existence and never
Yes.
anymore, right? How can we be sure that once all 21 million Bitcoin have been mined, no new Bitcoin would be created ever?
Sure. Well, the rules of the system are encoded in software, and the software is open source. And now, at first glance, that would seem to be easily changed, right? You say, well, it's just code, and someone could change the code. But that software actually runs on 100,000 or more. We don't know exactly how many, but 100,000 would be a good number of nodes around the world. So people like me, myself, who understand Bitcoin, run Bitcoin, and businesses that utilize Bitcoin often run their own node. So in order to change the rules of the software, which you would have to do to break that 21 million, you got to convince all of us that we need to install your version, the version with your changes, right? And we've had these kind of fights before, and it wasn't until 2017 when my confidence in Bitcoin was greatly encouraged, because there was a group of insiders who were arranging to try and make a change to Bitcoin, and they failed. So the nodes won, the users won, and I realized, okay, I see who's in control of this system for real. And it is the people, so to speak. It's the users. And then I said, maybe they've finally done it, because this was the dream, right? The dream of decentralization, the dream of non-government thing. There's no institution behind it. And here was a powerful inside group that got together, tried to change it, and they fell on their face.
So there's a lot of discussion about a Bitcoin cycle. How would you explain what that cycle is?
Sure. Well, the easiest way to look at it might be to look at a log chart, and I'll pull up a chart here in a moment. But the Bitcoin has its own calendar. So we think in terms of years and days. Bitcoin thinks in terms of blocks, or at least it's a blockchain. You've heard the term, but it is literally we're at 800 something thousand blocks, and those are blocks of transactions. And every time we add another block of transactions, that's sort of the time unit of Bitcoin. And what happens is, as Bitcoin was launched, we had no way to release it into existence. You can't just give it out. You have to kind of give it to people who did something to earn it. And that process we call mining, by analogy. And so Bitcoin mining, miners, when they discover a block or they get to add a block to the blockchain, they get a reward for that. And that reward started out at 50 Bitcoins. But after 4 years, approximately, really 210,000 blocks, every 210,000 blocks, we cut that reward in half. And this has an important effect in that it especially in the early days, it made Bitcoin more scarce. So in the early days, Bitcoin it circulated without any monetary value at all. So people were, in fact, giving it away because they could just mine Bitcoin for free on their computer. It didn't really cost them anything, and nobody attributed any value to it. But today, as a Bitcoin miner, I can tell you, we consume something in the order of $30,000 to $50,000 of electricity to produce a Bitcoin. Okay, so it has a real cost, a cost measured in megawatts, which is work. We call that system proof of work. And it gets harder every 4 years. So that's part of why we have this 4-year cycle in Bitcoin, is that we have this big step function every 4 years that makes it harder to get. Now, it just so happens that that lines up with the US political cycle and with the and with the macroeconomic kind of liquidity cycle. And we have some interesting charts perhaps I can share to look at that. When people are talking about the Bitcoin cycle, this is what they mean. Now, it's very important to look at this on a log scale. So I don't know if you're not familiar with log scale charts, we're dealing with exponential phenomena here. So you have to have orders of magnitude for each, for the Y part of the axis. But here is Bitcoin since 2012, which is not inception, but it's about as early as a lot of the price data goes. And what you see very clearly is this long kind of bear markets, we call them, and then these kind of parabolic advances. This shows you S&P 500 market cap percent change and the US M2 money supply percent change. So this is all in percentage terms. So you can see they're all kind of growing together. Again, the cyclical nature of the chart is visible every 4 years. These impulses that we have, we had the last halving took place right around this point in 2020. It was in May of 2020. We just had another halving in April of this year. And then the last one prior to that was in 2016. So you see what happens is we generally have, and you can, if you zoom in on some of this stuff, you can see that within about 6 months after the halving, we typically get a bull market. But you see there's also factors like total liabilities by the Fed that may have something to do with the market dynamics, not only the intrinsic increasing scarcity of Bitcoin. And within the Bitcoin community, there's a lot of argument about whether it is entirely these macro forces that are driving this, or it is entirely intrinsic to Bitcoin. My own opinion is that these are both a factor and that they're lining up for a great cycle ahead.
So this halving took it down to how many Bitcoin that is released?
So we were at 6.25 per block, or about 900 Bitcoin per day. That was mined by all the miners that are participating. And that went down to 450 Bitcoins per day, or 3.125 Bitcoins per block. So it's a difficult time for miners right now. Most are under stress. The margins are reduced. And so it's very important in this industry to focus on your energy costs, because that determines your cost of production, and the efficiency of your hardware. So we do have new generations of hardware that come out, and each one adds some percentage of efficiency. So as your fleet ages, you have to be lower and lower down the cost ladder in terms of what your energy cost is for those machines to be economically viable. And so it's, some people say, like, I would say Bitcoin machines, if your power right now is 5-6 cents a kilowatt hour, there's a generation of 2 or 3 generations ago machine no longer profitable to run. You have to ship that to somebody who's got cheaper power. And that typically has been the dumping ground of miners, has been places like Venezuela, where they have very subsidized power rates. So yeah, that's what we do.
Interesting. Well, it's now time for the Golden Nugget segment, which is sponsored by the Naples Family Office Symposium, and where Steve himself will be a featured speaker at. It's going to be held this year on October 3rd and 4th. The Naples Symposium is focused on uniting family offices, wealth managers, and other sophisticated investors through leading experts adept at navigating today's intricate market dynamics. So go check out the Naples Symposium. The link is pinned in the comments section. So Steve, would you share how Bitcoin is deployed in the mining process? How much longer mining is going to be able to be excavating new Bitcoin before that final number of 21 million is hit?
Right. Well, I should have pulled a chart for this, but I'll describe it. The function is asymptotic almost, right? So we have 32 halvings in total. That takes us out to 2140. So the last halving is in 2140, at which point no more Bitcoins will be created. Now, 21 million is the number. Close. I mean, it's very close to 21 million. However, a lot of Bitcoin was lost in the early days because people simply didn't understand it, didn't know it was going to become very valuable. Today, people don't make the mistakes that they used to, but they still lose some Bitcoin from time to time. There's a lot of stuff out there to help you, and institutional help to help keep you, help you from losing, keep you from losing your Bitcoin. But we estimate that anywhere from 2 to 3 million coins is typically lost. So the true number in terms of what the final supply would be is something more like 18, 19 million. Now, of the Bitcoin that remains to be mined, we're basically competing to mine the last million plus Bitcoin at this point. And 80 or 90% of that is going to be mined over the next 10 years, with the bulk of that being mined over the next 4 or 5 years. So what I find that I would characterize it like this: we're in the golden age of mining, where Bitcoin has accumulated a very substantial value and is likely to grow in value through this period. And it's still possible to mine a lot of Bitcoin. Now, you can't mine as much as they mined 10 years ago, but we're still mining meaningful amounts of Bitcoin. And therefore, it is an excellent business to mine.
So, Steve, your company, Celestial Mining, focuses on off-grid opportunities utilizing America's abundant and clean natural gas. Take us through your process for mining the Bitcoin, who you partner with, et cetera. I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote, and it's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift, it's a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Steve as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video.